Welcome to today's Explainer. We're diving into a fascinating quantitative matrix today, and honestly, it presents a core paradox that has literally tearing virtual trading desks apart. We're looking at Meta. Here is the massive conflict we need to untangle. How exactly does a fundamentally elite company end up operating with a technically broken chart? So let's just dive right into this high-stakes question, because this is the ultimate battle to boot up our system today. We're setting up a massive conflict between the underlying fundamental data, which, as you'll see, is incredibly strong, and the market's absolutely ruthless price action, which paints a totally different picture. How do we reconcile a phenomenal business with a stock that looks like it's just falling apart on the charts? Let's kick things off with Section 1, the dialectical matrix, bull versus bear. The polarity here is just sheer. On one side, you've got the bull analyst pounding the table, championing elite 32.8% net operating margins and a staggering $81.2 billion in cash liquidity. I mean, it's a structural fortress. But counterattacking on the bear side, that analyst is pointing directly at a broken trend structure and the brutal reality of a 4.49% 10-year Treasury yield. And let me tell you, that yield acts as a massive macro headwind, severely pressuring growth multiples and completely stripping away market momentum. And hey, the bear's case isn't just living in a spreadsheet. It's about real-world friction. Think about this data point from a recent Gallup-linked report. 71% of Americans actively oppose AI data centers in their local area. For a company undertaking a massive infrastructure scale-up, this translates into severe permitting delays, political resistance, and reputational drag. It's a very tangible physical roadblock to growth. Which brings us right to the direct clash over Meta's aggressive spending, specifically their $19 billion Q1 capital expenditure. The bull views this massive spend as a strategic moat-building investment, something that widens their lead in AI and ad targeting. But the bear? The bear attacks it as a massive drag on free cash flow, calling it execution risk with a much thinner margin of safety in what is currently a very unforgiving market. Moving right along to Section 2, the fundamental valuation engine. Now, this is exactly why the bull treats Meta as a premium franchise that is currently sitting on the discount rack. Just think about a forward PE of 17.0 compared to a trailing PE of 22.3. That tells us significant earnings growth is still expected. And a PEG ratio of 0.89? That is incredibly cheap for a megacap platform with this level of quality and structural lock-in. And check out this specific number, 32.9%. Meta's 32.9% return on equity brilliantly illustrates their absolute capital efficiency. Even with massive, aggressive capital spending on all that AI infrastructure, Meta is still generating phenomenal profit from its equity base. It literally proves that the underlying monetization engine is firing on all cylinders. But, we do have to address the balance sheet nuance here. Total debt has indeed jumped to $86.8 billion, which means leverage has increased meaningfully. However, you've got to weigh that against that massive $81.2 billion liquidity buffer in cash and short-term investments. That buffer completely prevents the rising debt from acting as a distress signal. It's simply a company choosing to invest aggressively because it has the sheer financial strength to pull it off. Let's shift gears now into Section 3, strict technical indicator breakdown. Putting on our market technician hats for a second, this is a disastrous technical checklist. Meta is currently trading below every major moving average you look for. It's below the 10 EMA at 616.56, below the volume-weighted moving average at 617.27, below the flattening 50-day simple moving average at 621.80, and well below the 200-day SMA at 672.60. This definitively confirms a completely broken intermediate trend. The tape just does not lie. And the momentum metrics absolutely back this up. An RSI of 45.6 and then accelerating MACD crossover sitting at negative 6.51 prove the stock is stuck in a heavy repair mode. It has lost its intermediate and long-term structure. However, there is a tiny silver lining here. The average true range, or ATR, is easing from 21 down to 17.06. That suggests volatility is finally cooling and the bleeding might be slowing down. We also absolutely cannot ignore the origin of this technical damage. Consider this specific dynamic. The massive April 30th drop occurred on 52.8 million shares of volume. That is not just some routine pause, folks. That is a significant distribution event. Institutional money heavily sold off, and the charts clearly show they haven't yet stepped back in to repair that damage convincingly. Next up, Section 4, deconstructing the agent debate. So we're pulling back the curtain on our multi-agent LLM trading simulation. We use specific agents here, an aggressive analyst, a conservative analyst, and a neutral analyst. Each one brings a distinct logic to the meta paradox, ultimately culminating in a final decision by the virtual portfolio manager. Let's walk through their exact thought process. The aggressive analyst comes out swinging with a compelling momentum argument. They explicitly state that below the averages isn't a red flag. It's an opportunity born when the chart looks worst. Their logic? If you sit around waiting for perfect technical confirmation, like the RSI crossing above 50 and reclaiming the 50-day moving average, the market will have already completely re-rated the stock. You'll miss the optimal entry point on an elite franchise. But then the conservative analyst launches a rigid counterattack based entirely on strict valuation and risk frameworks. They argue that a broken chart and a negative MACD of negative 6.51 means capital preservation must come first. You simply do not buy expensive, high capex optionality when momentum is undeniably negative and macroeconomic rates remain this high. They demand to see actual trend repair before risking a dime of capital. That's when the neutral analyst and the portfolio manager step in to reconcile these two extremes. They absolutely respect the damaged chart, acknowledging the conservative risks, but they just can't ignore a high-quality franchise with a 17 forward PE that has started to stabilize rather than cascading lower. Their synthesized final decision, a cautious but constructive overweight rating. Which brings us to our final section, actionable multi-tranche execution plan. Let's walk exactly through the multi-tranche execution parameters generated by the desk. Step 1. Initiate a staged, cautious accumulation inside the 598 to 618 support base on weakness. Step 2. Keep your powder dry. Reserve capital to add aggressively only if the stock constructively reclaims that 50-day simple moving average at 621.80. And Step 3. Immediately pause additions if we see further AI spending expansion without corresponding operating leverage. And of course, as with any great trade architecture, you must explicitly define the risk trigger. The strict invalidation rule here is a decisive break of the recent support base in the low 600s. If the technicals fail to hold that line, the fundamental setup is entirely invalidated for the near term, and the trade absolutely must be cut to protect capital. Finally, we have to talk time frame. You need to emphasize the target time horizon required for this setup to actually mature. The simulation targets a 6 to 12-month window. This isn't some quick scalp. It requires patience, relying on those massive AI investments to actually convert into tangible free cash flow and operating leverage over the medium term. Which leaves us with this final provocative thought. You've seen the elite fundamentals, and you've seen the severely damaged technicals. Will Meta's massive AI infrastructure gamble build an impenetrable global moat that massively rewards the aggressive buyer? Or will it crush its near-term returns under the sheer weight of all that capital expenditure, proving the bears right? Do you trust the fundamental code, or do you fear the macroeconomic virus? Well, the data's on the table, and the choice is yours. Thanks for joining me on this explainer, and keep learning.